The federal government now spends more servicing the national debt than it spends on the Pentagon, by roughly $100 billion. Let that sink in. We spend more paying interest on money we've already borrowed than we spend on the entire Department of Defense, the largest, most capable military in human history. That's where we are. The total national debt just crossed $39 trillion. The annual deficit is $1.8 trillion. As percentages of GDP, that's roughly 127% and 6%. Both numbers are bad. The trajectory is worse. And we are now in territory that historically great powers do not exit without significant damage. I want to say this plainly. In my view, coming to grips with our national finances is the single most crucial long-term challenge the United States faces. Other threats, geopolitical, technological, military, political, get more media attention and more political oxygen, and they deserve attention. But none of them, on a multi-decade horizon, has the structural capacity to unmake this country the way an unmanaged debt trajectory does. The other problems are problems we can address while we are powerful. This is the problem that determines whether we stay powerful. I'm not going to walk you through specific tax brackets or spending line items today. This is the 30,000-foot view. The problem, what happens if we don't deal with it, and what a serious response would look like in broad strokes. Government debt is not exotic. It works the same way as your mortgage or car loan. You borrow money, you owe interest on it. Every year the government runs a deficit. It has to issue new debt to cover the gap. That new debt comes with interest payments. Those interest payments become part of next year's spending, which means next year's deficit is bigger, which means more debt, which means more interest, which means a bigger deficit the year after that. It is a self-reinforcing cycle, and we are deep inside it. There's a second mechanism running underneath the first that makes the trap tighter. The market for Treasury bonds is a supply and demand market like any other. All else equal, the more debt the government has to issue to finance growing deficits, the higher the yield it has to offer to find buyers for all of it. That is true even before anyone starts questioning our creditworthiness. It's just basic price discovery. Flood the market with more bonds, the price falls. The yield rises, our interest costs go up. The bigger the debt pile, the worse the math gets. If your tax revenues were growing fast enough to outrun the interest, you could break the cycle. We're not doing that. Not even close. And every additional year we spend inside this cycle, the cost of breaking out of it goes up. Being this deep in the trap has a concrete consequence, and it's not hypothetical. The next time we hit a serious crisis, we may not be able to respond the way we have in the past. Think about what the federal government actually does during a real shock. In 2008 and 2009, when the financial system seized up, Washington pushed through trillions of dollars in combined stimulus and bailouts to stop the economy from collapsing. In 2020, when COVID hit, federal pandemic spending exceeded $5 trillion across multiple congressional bills. Both times, large-scale fiscal action was one of the central tools. And both times, it worked, in the sense that the economy did not implode. Now consider what each of those crises looked like at the starting line. Going into the 2008 financial crisis, federal debt was around 64% of GDP. Going into COVID, it was around 107%. Today, we are at 127% and still climbing. So the question is not whether we could do another emergency response. The question is from where? When the next shock arrives, and it will arrive, they always do, Washington will be writing those checks from a worse fiscal position than it has ever held. Bond markets will demand higher rates. The interest bill we already cannot afford will get heavier. And politically, the appetite to greenlight trillions of new spending shrinks the bigger the existing debt looks. Even legislatures who would normally back a stimulus will balk because the math gets uglier every year. The risk is not that the government refuses to respond. The risk is that the response is smaller, slower, and more expensive than it needed to be. That gap between what the moment requires and what we can actually mobilize gets paid in real economic damage. Lost jobs, failed businesses, longer recessions, real suffering, traceable directly to the fiscal hole we refuse to fill in time. We do not get to choose when the next crisis hits. We do get to choose what shape we are in when it does. I also want to be clear about what the end of this road actually looks like. There are two paths a country in our position can end up on, and we should look at both. The first path is inflation. This is the one most heavily indebted countries actually take because it is politically easier than the alternative. You do not formally default. You just let the central bank monetize the debt, print money in plain English, and pay your creditors back in currency worth less than what they lent you. The bondholders get the dollars. Those dollars buy substantially less than they used to. Savings gets gutted. People on fixed incomes get crushed. The middle class watches its purchasing power evaporate. The debt gets paid. It's just paid by the people who held savings, not by the people who took on the debt. This is Weimar Germany. It is modern Argentina. It is historically the standard ending. The second path is outright default. This one is rarer because it is much more dangerous, particularly for us. Treasury bonds are held by every major central bank in the world, by every major pension fund, by every major insurer, by foreign governments, by ordinary Americans through their 401ks. They are the foundational safe asset of the global financial system. A formal default by the United States, even a brief technical one, would freeze the global banking system in ways that have no real historical precedent. No defaulting nation has ever held the world's reserve currency at the time of its default. Either path produces an economic dislocation of historic proportions. Taxes will have to rise, hard. Spending will have to be cut, hard, including entitlements, especially entitlements. The inflation path is slower and more politically survivable. The default path is faster and more destructive. Both are paths that nations in our fiscal position have walked before. The unique twist for us is that we are the world's largest economy and the issuer of the world's reserve currency. But that does not make us safer. It means we have further to fall. These are not theoretical scenarios. History is unkind to nations that lose control of their finances, and the historical record is full of empires that walked one or both these paths. Two examples should suffice. The Ottoman Empire ruled 3 continents for 600 years. Then, in the 19th century, it started borrowing from European banks to finance wars and modernization. By 1875, debt service was consuming more than half of state revenue, and the empire defaulted that October. 6 years later, European creditors imposed something called the Ottoman Public Debt Administration, a foreign-controlled body headquartered in Istanbul with the legal authority to collect Ottoman taxes and remit them directly to bondholders' banks in London and Paris. Roughly a quarter of imperial revenue passed through this body before it ever reached the Sultan. Contemporaries called it a state within the state. The empire that had twice besieged Vienna now had foreign creditors collecting its taxes inside its own capital. 40 years later, the empire ceased to exist. Britain came out of the Second World War a victor, on paper. It also came out with debt at roughly 2.5 times its GDP, and a pound dependent on American goodwill. The decline that followed was not subtle. In 1947, India was let go. The United Kingdom could no longer afford to hold it. In 1956, the United States forced Britain to abandon its Suez campaign by threatening to crash the pound on global markets. The empire that had ruled a quarter of the world's surface a generation earlier could not run an independent foreign policy because of its balance sheet. In 1976, the country that had helped found the International Monetary Fund had to crawl back to it for the largest emergency loan in the fund's history, accepting dictated cuts to its own national budget in exchange. The Economist's verdict that year was 3 words: the British government is bust. Britain remained a wealthy democracy, but the empire was over, and finance had ended it. 2 different empires, 2 different centuries, the same lesson. None of these countries collapsed overnight. None of them, in real time, looked like nations that were running out of options. Right up until they were. Now, every one of those examples will produce the same objection from someone listening to this. None of those countries held the world's reserve currency. The United States does. That changes everything. I want to take that argument on directly, because it is the strongest counterargument to everything I've just laid out, and the one almost everyone reaches for. But to answer it, you have to be clear about what you are actually defending. Our currency is fiat. It is not backed by gold. It is not backed by anything physical. It is backed by the full faith and credit of the United States, which in plain language means it is backed by the world's confidence that the United States is stable, powerful, and going to honor what it owes. That confidence is why we've been able to borrow at the scale we have. The world's central banks, pension funds, and sovereign wealth funds park their savings in our debt because they believe we are the safest place to park money. That belief is the foundation of our entire fiscal posture, and it is what reserve currency status actually means in practice. Now, the full version of the counterargument runs like this, with a touch of hyperbole on my part. The United States is different from any historical case. We are the world's reserve currency. There is structural global demand for dollar assets that will keep absorbing whatever debt we issue. The normal rules of debt sustainability do not apply to us because we sit at the center of the global financial system. We can run deficits other countries can't. The math that catches up with everyone else does not catch up with us. That argument is not crazy. There's real truth in it. Reserve currency status does give us flexibility that other countries do not have. It does keep our borrowing costs lower than they would be on the fundamentals alone. It is a genuine economic advantage, and I'm not going to pretend otherwise. But here's the problem. Reserve currency status is not a permanent property of the United States. It is a perception. That perception rests on 2 contingent conditions. The first is that no credible alternative emerges. The second is that lending to America continues to feel low risk. Both of those conditions have held in our favor for the better part of a century. Neither is guaranteed to hold for the next one. History is unkind to nations that confuse a contingent advantage with a permanent law. British pound sterling held reserve status before the dollar. The Dutch guilder held it before the sterling. Spanish silver held it before the guilder. Each of those transitions was recognized only in retrospect, after the lenders had quietly moved on. We would not be the first country to assume our position was structural. We would be the first to be right. In my lifetime alone, we have seen 3 events that nobody saw coming and that reshaped the global economy. September 11th, the subprime mortgage crisis, and COVID. 3 black swans in roughly 20 years. We do not need to predict which specific event would change the perception holding our reserve status in place. We only need to recognize that on a multi-decade horizon, something almost certainly will. Just take one example among many that could be drawn. What happens if the Chinese Communist Party invades Taiwan? What happens if they succeed? Japan currently holds a substantial chunk of our debt. Do they keep buying it after a successful Chinese campaign in their backyard? Does Beijing pressure them to stop? How do European governments react? Does the dollar keep its reserve currency status? I'm not saying this scenario is likely to happen. I am just pointing out that we have built our entire fiscal posture on the assumption that nothing like it can happen. And history says things like it can happen. But here's the good news, and I mean this. The solution to our national finances is not a mystery. We need to bring the federal deficit down to no more than 2% of GDP on a glide path over several years. That's it. That is the target. 2% matters because that is roughly the long-run growth rate of the U.S. economy. If your deficit grows slower than your economy, your debt to GDP ratio shrinks every year, even if you never run a surplus. The hole stops getting deeper relative to the size of the economy, and over time, it gets shallower. Getting there requires both more revenue and less spending. Anyone selling you a plan that uses only one side of the ledger is not being serious. The hole is too big. The math doesn't work. We do it gradually. Phase reductions over multiple years so the economy can absorb each adjustment, and so we can ease off if revenues come in stronger than expected. And here is something that does not get said enough about fiscal repair. The benefits run much wider than the federal balance sheet. Pulling demand out of the economy puts downward pressure on inflation, which gives the Federal Reserve cover to cut interest rates. The bond market also rewards a credible deficit reduction plan by demanding less yield to lend us money, so Treasury rates fall on their own. And because so much of the rest of the credit system is priced off Treasuries, mortgages, car loans, small business loans, corporate borrowing, those rates fall too. The government's debt service gets cheaper. Household debt service gets cheaper. Business borrowing gets cheaper. The medicine does not just partly pay for itself. It pays a dividend to almost anyone in the country who borrows money. As an aside, I just want to flag one specific thing on the spending side, because it makes me genuinely angry. On the 27th of April, 2026, the Government Accountability Office released its annual report on improper payments, money the federal government either should not have sent out or sent out in the wrong amount. The number for fiscal year 2025 was $186 billion. That is $24 billion higher than the year before. And the GAO will tell you the real number is almost certainly larger because the report only covers programs that actually disclose this data. Several known high-risk programs do not. And improper payments are just one slice of the problem. GAO's broader estimate of total annual fraud against the federal government, that is money obtained through willful misrepresentation, runs from $233 billion to $521 billion a year. At the high end, that is roughly 7% of all federal spending. 7 cents out of every dollar the federal government spends is fraudulent. Sit with that for a second. Some leakage in a $7 trillion operation? Fine, I get it. Things slip through. But 7%? Cutting that number in half, not eliminating it, just cutting it in half, would take a significant bite out of the deficit before we even touch a single program or raise a single tax. This is the lowest hanging fruit in American public finance, and we are not picking it. But even if we squeezed out every dime of fraud, the structural math is still very tough. I want to be honest about what the broader fix actually looks like, because anyone who tells you fiscal repair can be painless is selling you something. Closing the gap from a 6% of GDP deficit to 2% means cutting 4 percentage points of GDP out of the federal balance sheet over time. In today's economy, every 1 percentage point is roughly $300 billion. $300 billion every point. Real money coming out of real programs. Real tax bills going up. Even after we squeeze the fraud and improper payment numbers, after we take every easy win we can find, the math still leaves us with hard choices. Programs people rely on will be trimmed. Taxes people pay will go up. Subsidies and deductions that whole industries and whole demographics have built their planning around will be on the table. There is no version of this that does not produce real losers, and a lot of people in the middle will feel the squeeze. Political resistance will be ferocious, and it will not be irrational. The constituency for any specific program is concentrated and motivated. The constituency for lower deficits in the abstract is diffuse and quiet. That asymmetry is why we are in this hole. It is also why getting out of it requires a kind of political seriousness we have not seen in a long time. I am not promising this will feel good. I am saying the alternative feels much, much worse. I know what some of you are thinking, because I have thought it too. Maybe AI saves us. Productivity surges, GDP rips, the debt becomes manageable in real terms. Maybe. The current models are generally impressive, and they will get better. Real productivity gains are probably coming. But high single-digit or double-digit GDP growth sustained soon enough to outrun the deficit? That is a much bigger claim. Adoption takes time. Measurement is uncertain. Labor market disruption could drag on growth before it lifts it. We are still figuring out how AI shows up in national accounts. Building your fiscal policy around the best-case technological scenario is not a plan. Just like crossing your fingers and toes is a posture, not a strategy. The bottom line is we either deal with this on our own terms, on our own timeline, with the ability to calibrate the plan, or we wait and we get dealt with by global debt markets at a moment of their choosing, on terms we cannot negotiate. Those are the two options. There is no third one where we keep doing what we're doing and it works out. Eventually the ball is going to drop. This isn't an ideological question. It is an arithmetic, economic, and history question. You can be a hawk or a dove, a progressive or conservative, it does not matter. A country that finances its consumption by absorbing the savings of the rest of the world is not running a real economy. It's running a financial illusion. Eventually, the illusion ends. The only question is whether it ends on our schedule or somebody else's. We can still choose. For now.